What's up, y'all? It's Dr. David Roney. I am actually doing day 22. I didn't just park, but I'm hanging out with the man, the myth, the legend, Jim O'Shaughnessy. If you haven't met him or you haven't seen the meme lord, I get to steal his background, right? Also, shout out to O'Shaughnessy Ventures, but that's another thing. All right, so today we're talking about value investing versus growth investing. These things are important to know because right off the bat, a lot of people throw around a lot of bullshit jargon, so we're just get rid of that. One of the things you have to know right up front is the averages are very important. So price to earnings ratio, price to book, and by book, what they mean is the book value of the company. That's the company, how much it's going to sell for, right? That's like, hey, you get rid of everything, you liquidate it all. It's like if you needed to have an estate sale, you need to get rid of things quickly. How much can you sell for it today and how much can you get for it? That's how much that company, that's the book value, right? Price to sales, how much are they selling? And so what that means is what an investor is willing, that price the investor is willing to pay today for the amount of earnings they have, for the amount of book value is there, for the amount of sales that is there. Those values are important. There's other things that are going to be in there, like how much they're actually earning year over year, quarter over quarter, yada yada. Those things are you're going to find in a balance sheet. You can go to like a 10Q or 10K and look at those per quarter. That's why it says 10Q or K for annual. And you go through and you look at those things, and that will help you figure that out. But a lot of people are going to talk about, hey, are you a value investor or you're a growth investor? All that means is, hey, are you paying a low PE or low price to book or low price to sell, or hey, I am a growth investor. Those are usually higher PE, higher price to book. And that just means people are willing to pay more for the possibility that it's going to grow. Typically, growth companies are going to be companies that are younger. They're going to grow theoretically. These days, people think that they're tech companies more than likely. Those are growth companies that we tend to associate. People think like, hey, they want to catch the next Tesla. But in reality, now value companies, traditionally, if you go back to Ben Graham, the intelligent investor, you think of Warren Buffett, everyone talks about value. In reality, what happens is if a company's too high, right, or if it's still going, eventually it has to revert. They're talking about revert back to the mean. And what you're looking for is companies that are quote unquote value. They're cheap because the market's not valuing them, and they're going to revert back to where the median or the average of the market is. So if the average PE of the market is 15, right? So anything less than 15, that's very simple. The PE, that's going to be more value based. Anything that's higher, you can think of it as growth. That's very simple, but right off the bat, like you're going to know some industries are associated with being growth industries. Nowadays, you can think of AI, those type of companies. And your value-based companies are things that sort of fall out of favor in the market. Right now, given the push of sort of ESG, environmental, social governance, that's just basically socially responsible investing. You can look at companies that have fallen out of favor, like basically tobacco companies, oil companies. You're going to find a lot of those companies have low price to earnings because people aren't willing to pay a lot of money for those companies, even though they might still be a good company, right? One of the things that Warren Buffett, he used to go around, and Ben Graham used to talk about finding cigar butts. And those are companies that are basically selling less than their book value, right? And they said, they can get one last quote unquote smoke out of that, one last real big push financially out of that. Warren Buffett sort of changed when he met Charlie Munger, and they started to go for sort of cheap companies that are really great, right? So the market's mispricing them currently. You have to understand these things when you're investing, or you don't, and you just get a damn index fund. But for those who don't want to get an index fund, these are things to understand about investing in general, is that you got to understand the different nuances of fundamentals, right? And understand how to read a balance sheet. Really take the time to go and learn how to do these things. If you're going to look on YouTube, you can go through a whole bunch of different aspects they'll teach you line by line on how to read a balance sheet. I did that for a long time, where I wanted to, every time I needed to refresh on how to read a balance sheet, I would go through and look at the YouTube videos. Bill Ackman actually has an hour course here on YouTube. If you go and look, He'll go through all the different aspects of finance and investing. It's actually pretty good. It takes about an hour, hour and a half. But you can find these things and really take the time to learn how to do it. If you're ever going to invest in individual names in the market, you need to actually understand what you're investing in. Part of understanding what you're investing in, because you're going to be investing for a long time, is actually understanding the fundamentals of the company that you're investing in. Now, trading's a whole different ballgame, right? Trading is not based upon fundamentals. Fundamentals, your price to book, your price to earnings, all these things you're thinking of, those statistics, right? They're very simple, but those things get borne out over time, right? So if you're investing today, don't expect it to be reflected, like your thesis, to pay off tomorrow. Like, these things take 3 to 5 years, like Warren Buffett says, that's the earliest you should think about it. I just recently sold one of my investments because my thesis went to shit right off the bat. The earnings of it got pulled forward during the COVID pandemic. It was a growth company, and then it freaking bottomed like crazy, and I was left holding the bag. And then I had to admit to myself, my 3-year period is up, and it didn't do as well, and I missed my opportunity to sell. So I need to eat that loss. So understanding these things, that, hey, no matter what you invest in, it's going to be risky. Not all your investments are going to work out, but you got to understand the difference between value. And again, you're just hoping that the market starts to value it correctly at some point, but you buy it cheaply and it reverts back to its average. Anyway, I hope everybody's doing well. This is day 22 of 31, and we're making it, man. Thanks for the support. If we get to 500 views, I'll hire somebody to do something with these videos other than what I'm doing, my cheapness. And I appreciate the support. Please follow me on Twitter at FISURGI, Surgery. Don't ask me about the name. But I appreciate everyone. Talk to you later. Stay blessed.